why did gold move down, any break below it, that we're headed lower and we're going to go into a multi-year, not just a multi-month correction. I think it's because the price was so exaggerated to the upside, it would take a lot more for it to move up.
Are you short-term tactically bullish or bearish as of now?
I have to be.
Gold is seeing a massive one-day breakout now at $4,300. Yeah, right at $4,300, and it's been trading sideways around $4,000 for quite some time. So the entire community has been waiting for either a breakout to the upside and downside, and it looks like it's breaking out to the upside. The question is, how long can this momentum sustain? Gary Wagner, editor of the Gold Forecast, has been on the show several times and has been calling for exactly this kind of breakout, and it's happening right now. Very opportune time to have you back on the show, Gary. Good to see you again.
Thanks for having me, and it certainly is. We saw an exciting move. I haven't seen this in quite some time. No one has seen gold move this high in quite some time. And it is the breakout that we were waiting for. As you'll see when I pull up a chart, we could have broke to the upside or downside because of the pattern, a Western pattern we identified, and it broke to the upside, a clear breakout. I'll talk about resistance levels. I'll talk about a new support level.
Let's pull up a chart. And I always get very cautious because I've been looking at this market for years, you and I, and well, you longer than me, but ever since I started doing this a couple of years ago, every time it's gapped up or down to this kind of, with this kind of scale and speed, it's always a bit concerning because it kind of reverses the other way very quickly. And, in the past, when gold has broken out of a consolidation range, it's taken some time to build up. And here we're looking at a literal, 5.5% move yesterday. That's very, very unusual and kind of scary.
Absolutely. Well, I don't know about scary, but I've pulled up a daily chart. This is the continuous contract of futures now representing December. And as you can see, what I've identified is it's a kind of a symmetrical triangle pattern with one deviation. We have a descending top and a flat bottom. The descending top, of course, is based on a series of lower highs. That's where you see these red arrows come in. And that also defines the upper level resistance line, as well as major support. As it fell, we had a couple of attempts to form a bottom. The one at around just about 4,500 in May. We had a consolidation then below that, 4,400. And then we just kind of went down to our final retracement, considering that gold hit an all-time record high as well as closing price. The high came in roughly at about 5,500 basis the continuous futures contract, and from there moved down to 4,000. So we're looking at a $1,500 retracement after hitting a record high. Now, the question is, will this breakout today hold? And that's something time will tell. It's going to depend on how the Fed reacts, what their statements are as we await the next FOMC meeting, in which a probability is pretty good of a 0.25% rate hike. We haven't seen a rate hike in quite some time. That's going to define it. The most interesting thing to me is the fact that the basic parameters, the primary moves in gold that we would expect to see, didn't occur. And what I'm referring to is the Iran war, the military action between the U.S. and Iran. Typically, when you have uncertainty, especially geopolitical uncertainty and war and strife, you see gold spike higher. We saw the opposite. In the time that they started the military action, the U.S., into Iran, we've seen gold stable and lower. And so that has always been a primary factor of uncertainty, because that ratchets up geopolitical uncertainty. Of course, we have a lot of trade, oil being one of them, coming through the Strait of Hormuz. And the fact that they could effectively control and stop that trade from moving globally is a big concern economically for the entire world, not just the U.S. In the U.S. and Canada, we produce a lot of our petrol products. We produce a lot of oil, which is what we convert into those products as well. Gas and oil, heating oil, all of those things, as well as plastics. And so when a big component. I believe 15% of the oil, 20% of the trade comes through the Strait. And the fact that it was controlled by Iran and they stopped that, we still haven't really fully opened it. The talks and the move we saw yesterday was predicated on the fact that we felt a big chance that there wouldn't be any more military action. We'll have to see.
Yeah. Let me switch over to my chart here. I'm trying to see, you gave a very good macro setup here. I'm just trying to see what moved gold yesterday. Gold in the past couple months has been responding to movements in the 10-year yield. It doesn't look like that was the case on the 5th of August because the 10-year already moved down on the late on the 4th, and gold responded later. Let me just see what the dollar did here. I'm just trying to see what triggered this kind of move, because these kinds of moves in the gold market, like as you know, they don't just happen randomly for no reason. The dollar has been relatively muted in the last 2 days, right? Yeah, I'm trying to find a trigger. Can you help us out here?
Yeah, well, I'll tell you my interpretation of it. Whether it's right or wrong, time will tell. But what we saw yesterday was a textbook case of market sentiment shifting in a major way. Because as the market moved up and hit the record highs, we were exceedingly bullish in gold. We saw it move from tremendous levels, gaining huge amounts. And then once the correction began, let's call it 5,500 as the top. Those were the closing prices, not the high, a little above that, moving down to just about 4,000. And I believe the traders saw 4,000 as an opportunity to reevaluate gold and re-enter the market. It's very iffy as it moves up. But as it moves down and then forms an extended base, about a month in which we saw gold not being able to break below effectively on a closing basis on a daily chart, not effectively able to close below 4,000, there was a point in time in which market sentiment shifts, and it shifted in a big way. In other words, I don't think it was fundamental events, although the talk of calmer action in the Middle East, the talk about the Federal Reserve not being as aggressive as we thought they might be to pare down inflation. I think what we saw was a textbook case, a classic example of a shift in market sentiment. The psychology behind whether we think it's overbought or oversold shift from bearish to bullish. Because remember, the last time we hit a record high, call it 2011, 2012, and it runs from 1,000 to 2,000, it entered a multi-year correction in which it sold off until about, I believe, the end of 2015, the beginning of 2016. I remember in February of 2016, it's sitting around 1,000 and it popped up tremendously. The next day, it was revealed that George Soros was effectively buying a lot of gold. He thought it was the bottom and everyone followed suit. But it would take years for the correction to kind of run through. And it would also be a tremendous move, almost a 50% drawdown from about 1,900 down to 1,000. And that's a huge drop in the price. This time we saw a multi-month and not a multi-year correction. Seems like things are moving at a much faster pace, in which it did find the floor at 4,000. And there was a point when market sentiment shifted. The way the professional and speculative traders view the market. And I think that's what we're looking at rather than a specific event that triggered that huge dynamic move yesterday.
Before we continue with the video, let's talk about a company that's building serious gold leverage for the long term. Our sponsor today, Stellar Gold, is sitting on 3 major Canadian projects. Tower and Colomag are among the largest undeveloped gold sites in the country. The Tower project alone could be worth $2.5 billion after tax at a $3,200 gold price assumption. And if prices go higher, so does its value. Colomag spans over 1,000 square kilometers of greenstone deposits and could be Canada's next big gold camp. They also have Hollinger Tailings, a cleanup project that could deliver near-term cash flow. Across all projects, they've drilled over 16 million ounces of gold, which would cost over $2 billion to replicate today. With a seasoned team, Stellar Gold is one company to watch. Scan the QR code here on screen or visit stellargold.com/David Lin to learn more. If I were deciding if I should be a buyer of gold right now based on yesterday's move, looking at this chart that you have on the screen, Gary, I would probably tell myself I'm going to wait for gold to break above 4,400, the resistance level you've outlined on the red line there, before I can confirm the upward trajectory is sustainable. That's my read. What do you think?
Well, we've got to look at, I had major support at 4,000 based on these lows that came in right here. Obviously, when we had this huge spike and breakout above these kind of tops, these candles that came in around 4170, that was huge. And so when we look at, there's the wick, meaning the differential. Let me go to full screen. When we look at the wick, the differential on a candlestick in green, the open and close signifies that the market closed above its opening price on a daily basis. These upper level wicks signify the intraday high and the intraday low. So yesterday's action, it closes very near the high, closes about 43, and the high that came in was about 43.23. Now today we had the highest high since the sell-off. If you look, it came in roughly at 43.60. I'm rounding up, but you have this rather large wick. This is called basically a shooting star, a candlestick pattern, in which you get this small type body. Typically, you want to see the body above, but we're looking at a continuous contract in a 24-hour market. So those kind of gaps typically can't happen unless there's a contract month change. But what I would look for is to see whether or not it pulls back. I'm calling major support right now just below 4,200. It would be a risky trade right now because we're at 4,300. So for futures traders with that $100 ability to backtrack on the downside is a real risk on the trade. On the other hand, anyone that wasn't positioned in this area, meaning got in at 4,000, 4,100, positioned themselves somewhere around here between call it Wednesday, the 24th of June, up till the breakout yesterday. We did have a breakout that came in above this descending top, and that was pretty critical. That occurred Wednesday the 29th, it's below, and then a week ago, Thursday, on July 30th, it goes above, and then it trades sideways. The fact that it traded sideways, I believe, was a bullish sign because market didn't move back down. But this breakout was huge. You know, I think about $178 on my chart, about a 4 to 5% move up. Silver also moved. And today we're trading roughly in the same area. That's bullish to me. As you pointed out, I see the next level of resistance at about 4,400. So to buy in at 43 and get out at 44 with a $100 risk it's a tricky play right there. And so what we want to see is really the market consolidating or moving higher. Consolidating wouldn't bother me at this new price level. A move up, I would want to see how it reacts at the next level of resistance, 4,400. It's based on this top here, as well as these candles here that came in March of this year. And the action here doesn't give us a clear indication in terms of historical, is realize that once we broke 4,000 and came back down, this base only aligns on a technical basis when we look back in time. There's no other time it really hit that level. This level here comes back, but these are all new prices. If you take a longer term view, and I'm trying to really scale this chart in, you don't see much action. Right here, you've got the 4,000, but then it runs up, and then you have these series of lower highs, and that's partially what I do base my levels of resistance on, because besides the activity that came in end of 2025, in which we saw some tops form, we had pretty much a parabolic move from the middle of January up until the end of January when it made its play. So based on that, it's a tricky trade, but I believe that gold has the opportunity to hold this. If we see it back off and retrace, say, 30% of yesterday's move, that's okay. In terms of, we don't have a lot of technical levels that it could trade through right in this particular area, because this is all new pricing up to the all-time record. As it retraced, this is all new corrections. So we're not looking at gold being range bound in the sense that when we looked at it trading, call it 2010, 11, 9, between 1,000 and 1,900, it was within $1,000 range. Now the correction itself here was 1,500. But when you consider when gold broke from 1,900, because it traded between that level back in 2012 and broke down, it broke hard and it broke consistently for a multi-year correction. If this, in fact, was the conclusion of the correction, which I believe there's a really high probability of that playing out, then we're seeing a brutal correction of about 1,500, but that's certainly not 50% of the price of gold. That's not 50% of the move, but it is significant.
Yeah, silver also had the same move, so it wasn't just gold. So it was entire precious metals complex. There we go.
Now we're looking at a silver chart. I believe I should actually change the back. I try to color code the back so it becomes easier for our viewers to understand what we're looking at. So now this is what I'm looking at in silver. I've got a basic Fibonacci retracement that begins not at the all-time record level, which is even back further than that when it traded around 120 per troy ounce. Tremendous move, comes down. We've got a series of tops that are unsustainable. I'm using the Fibonacci retracement from about $90 down to 55. And you can see a clear-cut kind of a base on the bottom of these. I'm also pegging my first level of resistance in silver at about $63.30. That's a Fibonacci retracement. Also matches up with the activity first week of June. If silver was to move above this on a closing basis on a daily chart, we've got some room between, I can add the 38, maybe I should. That would certainly help our viewers out.
Yeah, sure.
Okay, so at around $68. So if it continues to move, and the key is, unlike gold, which definitively broke above that series of tops, if we draw like a descending top down to here, the breakout itself occurred yesterday with a move in silver about 4.19%, or it gained about $2.50. The prior day, we saw it gain about 2.3%, or $1.35. So we saw the move, but in terms of percentages, it was almost equal to gold. We saw about a 4% move in gold. Yesterday, we saw the same in silver. Silver typically outperforms gold in terms of percentage gains on breakouts. It also outperforms gold on retracements and corrections. It tends to be a little bit more brutal. I believe that has a lot to do with the liquidity or number of contracts traded. It's much less than gold, but still, it came right up to this first level of resistance. We clearly saw the highs today really hit that in silver and then back off. So we need to see if it's going to hold in this level. If it retraces, I really wouldn't want to see it go below about $60.30 and maybe 61 right in there. That would give us an opportunity to buy this dip. Otherwise, we still want to be fairly cautious on silver.
Gary, the biggest bear narrative around gold and silver, well, specifically gold, that has been formulating over the last 6 weeks or so, and this is from all levels, from big financial institutions and retail investors alike, is the fact that higher interest rates is going to put more pressure on gold. The Bank of America lowered their gold price forecast to $4,300 by the end of the year because they expect interest rates to go higher, both on the short end and the long end. They expect the Fed to raise rates as well, and the bond market has been doing exactly what they predicted. We're at the top end of the forecast, so we'll see if they revise that. But anyway, my question is, Gary, have you considered how gold will react if the bond market continues to do what it's been doing in the last 2 months or so, which is going down as interest rates continue to go up?
Yeah, and there you've got a huge diversion between the reality of what's happening now and what they believe will happen later. I believe, as I said, what we saw in gold was a classic example of a major shift in market sentiment. Because as gold moved down, you had this series of lower highs. It's undeniable. And if we want to bring something else into the picture, I've just pulled up our that's our dollar index. I'm sorry. Give me 1 second. Our crude oil. I've got it in Heikin-Ashi format because when we convert it to candles, pure Japanese candlesticks, it doesn't look as clear as to what we saw. We're certainly not at this 101 level in crude oil. Crude oil comes down. The lows are accurate. The difference in the body of Heikin-Ashi is in a candlestick. The open is the true open on the day, whereas in a Heikin-Ashi, this type of chart, the open is based on the midpoint of the prior candle. So effectively, you get that chart smooth for that reason. And that's why you see these long periods of just red candles, bearish, long periods of green candles, bullish. And here we had a pretty standard market going down, even with these two greens. But typically in crude oil, you get long examples in which they're all red, they go to green and then red. Here, this shows me that traders were really uncertain. In terms of inflation, that's going to be highly tied to what crude oil does. And crude oil is highly tied to what's going on in the Middle East, whether they can get that supply out to the countries that depend on it. So if we take this back to a candlestick to get pure pricing. So for example, today, crude oil gained about 4%, but it's back around 78. I believe that if crude oil stays between 80 on the high end, 60 on the low end, you don't get a growth in inflation because that's an accepted level for years in crude. If you get a break above certain points or below certain points, a break above 93 would be dramatic in terms of the fears of inflation growing and technical evidence that it will, because we know if crude oil goes up for a sustained amount of time, all prices go up because we're so highly tied as a petro society. Whether it's gas or heating oil, there's so many products that come out of crude oil that when crude oil goes up, everything goes up. When crude oil goes down, things stabilize, but you don't see that equal match. You don't see it go down as quick. That's just the nature of the beast. But this is what we're going to want to see is if crude oil continues to go down or at least stabilizes its mid-range from this bottom at about 67 and the top at around 92. We're closer to the bottom than the top. We'll have to see if it continues or begins to trade sideways. In other words, consolidates. That's going to be the key to where inflation goes. But here's the thing. We had Wallace, our new chairman, come out with real hawkish tones. He's going to get inflation down to 2%. The only way the Fed can effectively change the level of inflation or pricing is by raising or lowering rates, because when you raise rates, obviously everything becomes more expensive to finance. But we didn't expect to see a rate hike on the last FOMC meeting that recently occurred. The September FOMC meeting has a pretty high probability according to the CME's FedWatch tool, of going up 0.25%. But then it becomes iffy when you look at the FedWatch tool, which, by the way, is created by the CME interviewing or polling major crude oil traders, interest rate traders specifically, forming the biggest component of that pool. and then polling them as to if they're bullish or bearish. That's what creates those numbers. And so they tend to have a high probability of occurrence. In other words, if it's exceedingly a high probability of a rate hike, we will typically see it. And so right now, the Fed Watch tool is showing a pretty high probability of a September rate hike of 0.25%, but we're not seeing much action to the end of the year where there's going to be 3 rate hikes, 0.25% each. So if we're only going to get 2 rate hikes, I don't see that as shaking up the economic environment here. If we get an unexpected amount of rate hikes, more than 2, that would shake things up the other way. But right now, even though Walsh is carried this big stick and waved it around, he hasn't raised rates, and the sentiment out there is that he's not going to do a big raise them 0.25% on 3 occasions. We'll see what happens next year. But right now, the anticipation is no more than 2 0.25% rate hikes.
Here's my, if I may add to that, Gary, here's what the markets are concerned about, which is that bond vigilantes are back. The bond vigilantes are going to do the job of the Federal Reserve, whether or not Walsh raises rates. So your commentary about how 1 or 2 rate hikes isn't going to be detrimental to the economy to a large degree, I think that's true. I think that's an objective, observation. But the 10-year and the 30-year yield will move up regardless. And so mortgage rates, consumer credit card rates, most of what we have in the economy, it's based on the 10-year yield. So if the bond vigilantes decide, you know what, we're gonna sell bonds and raise the rates anyway, doesn't really matter what the Federal Reserve does. That's number one. I'm concerned about that. I'd like you to comment on that. And then you brought up crude oil. As you were talking about crude oil, look at my screen here. Crude historically has had a very low correlation to gold. I mean, you could argue that oil going down has in the past signaled less economic growth, which may be good for a safe haven like gold. But that correlation between the two variables has tightened this year. And I just find that very interesting. As before, maybe a weaker gold could signal weaker oil could signal stronger gold and vice versa. Now, stronger oil could signal higher interest rates, which may push down gold. But it's just interesting how these variables move one way or another. One time they're having a close correlation, one time they're not.
Your points are well taken. Now, when we look at what traders are doing with the 10-year and the 30-year, they're not looking out short term. All of what I've talked about is a myopic view of a very short-term time period and price structure during that time period. End of this year, next year, a little bit. Mostly, I've talked about where I think it could go by the end of this year. Those bond traders, a 10-year, which is, as you said, the central vehicle that is looked at, is looking out through a periscope of 10 years from now. That's pretty hard to predict, but this is how they see it. 30-year, of course, is less sensitive because it's the longer time period that it's looking out before the bonds mature and the market gets to where it's going to go in that period of time. I think that when you talk about correlations, gold has lagged behind moves in oil because if oil spikes up, there's a time period to see if it's sustained. And if it is, there's a long lag to where we see prices act accordingly and move higher. As they do, of course, inflation pegs up. I think the most sensitive structure that traders need to focus on short term is Fed action. What statements are coming out of Fed members? What actions are going to happen in the September meeting? If we get just that small 0.25% rate hike, I believe that's largely factored into current pricing. And so when we look out for a large scope of time, what I found was most interesting this year to date, is the fact that we saw a basic shift in which gold reacted in an unexpected way to a ramp up of global geopolitical uncertainty. Gold typically reacts when there's uncertainty in the world. And what happened? We had a major conflict between the Middle East and the US. And what happened? Gold went down. And that to me is the most interesting thing that I'm trying to wrap my head around, because years past it would have spiked much higher. That would have given it the impetus to have traders step in heavily and move the price, and yet it went down. So what changed in gold in terms of its primary structure to react when geopolitical or uncertainty in the world factors higher? Why did gold move down? I think it's because the price was so exaggerated to the upside. It would take a lot more for it to move up, but I'm not certain that's all of the answer. It's a component in the answer, but that to me is the biggest quandary, let's say, of gold price action this year.
Okay, let's close off here. I think that was an excellent summary of what's been happening. Bottom line then, Gary, the key level for gold that you're watching for next. Are you short-term tactically bullish or bearish as of now?
I have to be bullish. Listen, obviously, even the most stout bulls got very bearish as they saw a series through the month of lower highs. That's what we look at. That is a classic example of a market shifting from bullish, which we saw on a multi-year level, up to the record high. I think that record high was so exaggerated above 5,500, it had to cool off. There had to be profit takings. We had to see it go to a level that was acceptable, in which traders would now perceive the market as a decent price to enter rather than as a price to sell. Obviously, at those record highs, that was a component in which traders were comfortable selling into it. We're not getting there. We formed a base at 4,000. The next level, I think, is going to be 4,400 if it continues to move higher. If it trades lower, and these are short-term observations, it absolutely cannot break below, call it 4,200. It's really 4,174 based on these series of tops. If it does, we have to say that this breakout wasn't sustainable, and we're still in a bearish high with absolutely 4,000 the line in the sand, 4,200 the first line in the sand to maintain a bullish posture. At 4,000, we have to acknowledge any break below it, that we're headed lower, and we're going to go into a multi-year, not just a multi-month correction.
Okay, good. Thanks so much, Gary. Tell us where we can find you.
Thanks for having me. First of all, we can be found at thegoldforecast.com. As always, if you put Lynn in the order coupon, you're able to get about a 30% discount. We want your subscribers to get as much value as they can. Thegoldforecast.com is where to go to see our work.
Excellent. Thank you so much, Gary. Appreciate your time as always.
Thanks for having me. Yeah.
Thank you for watching. Follow Gary in the links down below, and please do like and subscribe.